Welcome to Simple Wealth Wisdom Podcast. I'm your host, Gakhar. Each week, I bring simple financial security ideas for successful business owners and professionals like you to help you build and maintain your lifestyle and legacy. As an insurance and investments advisor, I work with business owners and self employed professionals like you. I see a lot of you are always looking for tax advice, accounting advice, legal advice, estate planning, and investment advice. When I work with you all, I always work with a team of lawyers, accountants, estate planning, and investment advisors. As your trusted advisor, I want to make sure that I bring the best to you. You usually hear everything from me, but now I feel through this podcast, I can bring all those people here who are my support system and you can hear directly from them. This is the reason I started this podcast where business owners and self employed professionals like you can always go and get the ideas and answers to their questions regarding how they can protect and grow their wealth in the most tax efficient manner. Again, being an insurance and investment advisor and specifically working with business owners and professionals, I feel each guest will bring a lot of value to you all. And today I have Mark Arruda from Sun Life as my guest. Welcome, Mark.
Thank you, Sam. Great to be here.
Thank you. Mark is a fellow of Society of Actuaries and Canadian Institute of Actuaries, as well as Chartered Enterprise Risk Analyst with the Society of Actuaries. He holds a Family Enterprise Advisor designation. As an actuary, he is able to look behind the curtain of many insurance designs and strategies and uses his expertise to really understand what is going on. Like many advisors and insurance specialists, Mark is a passionate problem solver and enjoys applying his skills within the insurance context. With over 20 years in the insurance field, Mark rounded his experience through technical positions in investments and valuation, as well as pricing and product development. In his current role as AVP of Insurance Solutions Enablement, is responsible for the activation of the Sun Life insurance product shelf and how those products help Canadians achieve lifetime financial security. His greatest satisfaction comes when he can see his contributions help clients make informed decisions. I'm very, very happy and I welcome Mark, you once again here.
Yeah, thank you, Sam.
People always hear from me, and now they are hearing from somebody behind the scenes, somebody who is actually a product designer, somebody who's actually an actuary. Now, I use this word a lot when we were talking actually, and somebody like, I would say, being an insurance advisor, I know what an actuary is. Accountants know, estate planning lawyers know, but not a layman, not everyone knows. So just to make it a little more clear so that everybody can understand what exactly do you do, please explain what is an actuary, what exactly do you do?
Yeah, exactly. Well, thank you, Sim, for having me here. Yeah, the term actuary, it's thrown around quite a bit. You'll see it sometimes in movies or in the insurance context. Really, it's a professional who is expert at assigning value to risk. That's what we're trained to do. We're trained to measure risks and assign values to them so that we can do things like pricing and product development in the insurance context related to life insurance, property and casualty, automotive. It's all about kind of managing and identifying risks.
Okay, wonderful. So I think most of the people can understand it better.
Yeah.
Right.
Yeah.
Thank you for sharing that. So Mark, according to you, is insurance widely utilized in Canada today? Because, everybody says that. Yes, I need insurance. I want insurance. But do you think with your experience, you come with 2 decades of experience. What do you think about that?
Yeah, so insurance, it's definitely utilized, but probably not to the extent that we all wish it was. I see it almost in 2 categories. One I call the mid-market space. So this is like, I call it like the family market, almost like selling insurance around a kitchen table. Right? And in that context, we actually see the utilization of insurance almost flatlining or even slightly declining. When I talk to people and tell them that I work for a company like Sun Life, they might say to me, oh, I'm a Sun Life client.
Mm-hmm.
And when I dig a little bit deeper on that, it's because they're a group insurance client. They're working for somebody who has a group plan, and that group plan is administered by Sun Life. But I don't really ever encounter people who are individual clients, who want individual life insurance from us. And because the reason for that is it's on a bit of a decline there. Now, where we see tremendous growth is utilizations of insurance for high net worth individuals, business owners, and ultra high net worth. This is where all the growth is coming for in the industry. I think there's still tremendous stigmas around insurance where people have preconceived notions about what insurance is all about, hence why my role exists to help them understand how insurance really works and how it can benefit individuals. And I think we can do even more to help those business owners and high net worth individuals utilize insurance. That's where the growth is, but I think there's still tremendous potential there.
You know what, Mark, I always say in every podcast, people know what insurance is, but they don't know what insurance does.
Yeah.
And for business owners and professionals, they really can get a lot from insurance, right? I know you have this designation FEA, Family Enterprise Advisor, and so do I.
Oh.
And I took this designation because I deal with enterprises, I deal with high net worth clients, I do their proper planning. And I feel after getting that, I really got to know where everything is lacking.
Yeah.
We think people who are, enterprises, companies, people who are big in their businesses, they have everything in place. It's actually not. And that's why I feel somebody like you can really come here and share your knowledge behind the scenes, what's happening and how it can actually help.
Yeah.
So now continuing that, I would like to say that what kind of products are available for them to use and which are the most popular and how are they designed? You're the designer.
Yeah, for sure. Well, it's great to meet another Family Enterprise Advisor. I think that that designation needs to be more widespread. In Canada, I think most businesses are actually family-run enterprises.
Yeah.
And they have a unique set of challenges that go even beyond product. You went through the program. It's really being the quarterback for all of the professionals surrounding the team, including insurance professionals as we are. Now, in terms of products that can help business owners, high net worth individuals, family enterprises, it's a full spectrum of products that we sell in the shelf across Canada. So from as simple as term insurance, which is really just covering temporary needs, these products expire after a certain number of years or by a certain age, like by age 85, much less premium, but they have very specific purposes, all the way to more complex products like participating whole life. So whole life insurance is insurance that when you purchase it, you're going to hold it for as long as you live. Mm-hmm. The point of insurance really is to ultimately to pay a death claim. So when you die, the insurance company will pay you a death benefit, and that death benefit will be used for a number of different purposes: liquidity needs, covering tax bills, dealing with credit if you have loans, covering off those loans, helping to equalize estates if you have multiple inheritors, multiple children. Insurance can be used to make each of those inheritors equal. Mm-hmm. So these products exist in order to generate cash when cash is most needed. Now, there's a lot of other benefits for business owners and high net worth individuals. Business owners and high net worth individuals are ultimately going to have to pay significant amounts of tax. That's just something you can't avoid. What is it? What's the adage? You can't avoid death or taxes, right?
Yeah.
Which is what insurance really exists to kind of help clients with. So these individuals are going to pay significant tax bills. Now, they are most likely surrounded by a team of professionals, accountants and lawyers who do tremendous work for these clients in terms of tax planning.
Right.
And particularly tax planning at death. We call that post-mortem planning in a lot of cases. And this is helping most efficiently deal with the tax bill to get the client to pay the most appropriate amount of tax. Now that works really well. What is most often neglected is the impact of combining insurance with that planning to really make the tax bill as efficient as possible for the client. When you combine these two things, you can get to a place where clients go from paying, business owner clients with no planning, going from paying 70% tax rates in many situations down to, with planning and insurance, can get down to as low as 20%.
Yeah.
And it's not about avoiding tax, it's about efficiently structuring your planning to get to the appropriate amount of tax that the client will pay. And then utilizing the liquidity elements of the insurance, the death claim, in order to pay that bill.
Right.
Now, the way that that's structured is assessing risk and the product for the client to get them to pay an appropriate amount throughout their lives in order to generate as much liquidity from the death claim as they can when they need it the most for the reasons of paying tax, paying bills, equalizing the estate, all of the above. And the products that exist in Canada are designed in a very effective way to do this very, very efficiently.
Wonderful. And I know that so many times I come across people who always say that yes, they need insurance, insurance, but they don't understand. So I just want to tell everyone that Mark is the person behind when you see those long illustrations and those number of pages. Mark is the one who's sitting behind and using his brain and coming out with these numbers with his team. So now, Mark, you said that it's very good for business owners. It can really help at the time of the need, final tax bill. And I've heard it many times that if there's no planning, you maybe 50% of your wealth is going to go away.
Maybe
more. And when there's planning, all can stay within your family, as insurance can be a big part of it and can save that. So can anyone purchase insurance?
Yeah, so anybody can apply, but unfortunately not everybody's going to qualify, right? And there's a couple of different scenarios here. So one is if you're a very healthy individual and relatively young, then you shouldn't have any stumbling blocks in applying and qualifying for the insurance. Now, this is all about a risk assessment. Insurance is essentially a risk assessment tool. So the pricing, the premiums that you pay for this directly correlate to how healthy you are. So if you're super healthy, you're going to pay probably the lowest premiums available out there. But as your health becomes more impaired, so you start having conditions like maybe you're overweight, or maybe you have high blood pressure, or maybe you've had a heart attack, or maybe you've had other conditions that might impair what we call your life expectancy, when the insurance company expects you to die. If that is impaired, then what's going to happen is we're going to probably increase the premium. The industry is going to increase the premium that you have to pay in order to get that insurance. But in some cases, the underlying health conditions could be so bad that you might not qualify at all. Now, in order to deal with that, the best tool to deal with that is timing. Get the insurance as soon as you can after assessing the need. So you talk to an insurance professional like Sim here, and you've assessed that, there's actually a need that needs to be addressed and can be addressed by insurance. Pulling the trigger on that purchase right away helps you avoid some of those unfortunate circumstances that might come down the road with changing health status, or to just determine whether you can qualify or not. If you can qualify and you're healthy, then pulling the trigger right away locks that in for the rest of your life. If you wait and your health status changes, you may have to pay more, or you might actually get to a point where you don't qualify. The other thing is, because it's a risk assessment and based on life expectancy, the older you are, the more you're going to pay, because you're getting closer and closer to when we expect you to die. So if you want to minimize the amount of premium that you want to pay for the particular benefit that you're getting, you pull the trigger right away as soon as you determine that there's a need.
Absolutely. And Mark, the startups, business owners who are just starting the business, or professionals, recent graduates, even if they don't have too much of money, as you said, that money cannot buy insurance. It's the insurability which buys insurance. So it's a great idea. As when we were talking, we talked about it's a great idea to have maybe get your insurability locked by buying a cheaper term insurance and which can be converted into a permanent insurance, and that permanent insurance can take care when your estate is going to grow. And when at that time, when the permanent need comes for the taxes on death, that can be converted, when we start making money. Great. And one more thing, while talking, you mentioned the word increased premiums. So I just wanted to make it very clear to everyone here that increased premium means you hear the word rating. Somebody says that advisor says to you that your policy is rated. Rated means the premium is more than a standard premium. As Mark mentioned that if there is health issues or the insurance company thinks this is a risk where the death benefit can come, the claim can come earlier than expected, then they increase the premium, and that is called rating. So Mark, does a person have to die to realize gains from the insurance products?
So, in assessing the need for the insurance, most of the time the assessment of the need is based on when the client's going to die and the losses that death brings. Now, that death can bring losses in terms of tax, triggering tax bills, or paying back loans, or dealing with estate equalization. It could even come in the form of things like income replacement. If you die early, I call this human capital. A person's human capital is the present value of all the future income that they're ever going to earn. Insurance is a great tool for replacing that human capital, right? With a term insurance product that Sim mentioned, can lock in your insurability when you purchase, and then you can later on, when your cash flow changes, new business owners, they have a lot of needs in their businesses and they need the cash in order to invest in those needs. They can purchase these less premium term insurance products that then can convert later on in life. Now, when you purchase that permanent insurance product, that permanent insurance product has a couple of features associated with it. One of which is a building cash value, right?
Yes.
The cash value is very, very important for a business owner, right? Because these premiums can be large in many cases. That cash value gives you some flexibility in being able to access or utilize that cash value for other purposes. As that cash value builds, you can access that cash value in various ways. So one could be withdrawing the cash value. Honestly, I don't recommend that because in withdrawing the cash value, you actually give up the death benefit that you've assessed in the need that you're going to need at some point in the future. So although that's an option, it's probably your less favorable option. The other two options for accessing your cash value are policy loans. So these are contractual rights that are in the contract for most products and most insurance companies, where if you want to access up to a certain percentage of your cash value, sometimes 95% of it, you can take a contractual policy loan from the insurance company with no financial underwriting, which is a huge benefit. If something were to happen to you financially and you weren't be able to get a loan from a bank, you can access the cash value in your policy through a policy loan with the insurance company. It's a great benefit if needed, but also not necessarily the best option in that you may have to pay some tax, depending on the structure of the policy, the age of the policy, and all of that. The most utilized way of accessing cash value in the policy is through collaterally assigning that cash value with a third-party lender, like a bank or another lender. There's actually companies that are popping up right now because this is so popular, where they can their specialty is just taking insurance cash values and providing loans to those clients for the insurance cash value. And then clients can use that cash value throughout their life. If they're a business owner, use the cash to reinvest in their business, replace the premium that they used in order to purchase the insurance in the first place. They could use it to supplement lifestyle. They can use it to invest. Investing within the corporation or in other assets could sometimes provide tax advantages, like deductibility of interest, deductibility of certain aspects of the policy that can really accelerate the value of that loan by minimizing the cost of it. So there's lots of ways you can access the cash within these products and utilize value within your life, so you don't have to wait 30 or 40 years in order to trigger the claim through death.
And you said it so well, and you explained it so well, Mark. And very especially business owners, they are the ones, for them, lending through the third party, through all major 5 banks do this lending. We have a lot of credit unions who do that. So assigning your policy to the third party to take the money out keeps the policy in force at the same time. You're not surrendering your policy, and you're not even going away from the cash, because whatever money you've paid into the policy, your policy has so much cash value that you can borrow against it from the third party. And then of course there is an interest that you pay when you borrow the money, and that interest becomes deductible.
if structured in the correct way,
In the correct way.
you utilize the loans. That's a good point, Sim, is that the third party loan, the policy loan, it actually doesn't impact the way that your policy grows over time.
Yes.
It's almost like it goes parallel to the policy, and you get the full growth, the full impact of that death benefit, while still utilizing the value within the policy unencumbered, unimpacted. So strong, really strong benefit. And that policy within the business owner context, it provides such incredible tax advantages. I've always said this, there's really no other game in town, I think, for a business owner in planning for liquidity need, tax advantaged within a business owner context than a permanent insurance policy. When you take into account things like the capital dividend credits that are
Yes.
generated within a life insurance policy, there's not a lot of tools out there that generate as efficient a capital dividend for a business owner than a permanent insurance policy. And when accountants, lawyers, clients see the impact of that over time and the outcome that it drives for the results of the business, they almost, I've seen it, they almost look at it like in disbelief. This can't be real, this can't be how it works.
I see it all the time.
It is,
I know.
right? It is. It's astounding to see, right?
Yeah, definitely. And now you are an actuary. I'm gonna say it again. And you're working behind the scenes in creating those products and the pricing. So what, according to you, are the common ways business insurance use life insurance? You've already talked about it, so let's discuss with an example to make it more clear to my business owner and my self-employed professional clients by considering a successful business owner. Let's say business owner has their own corporation, and with his investments in their corporation, and the money that they don't expect to use.
Yeah.
Okay, so I would like you to tell me, with that example,
Sure.
and they have retained earnings that they don't need to move out and pay tax on, can they benefit from corporately owned life insurance?
These are the individuals who benefit the most from corporately owned life insurance. So a lot of the times I like to call this never money. Business owners generate cash from operating their business. Probably their number one return is their business. At least, I've heard that referred to so many times, and they're generating tremendous returns in their operating company. Maybe they'll have holding companies that hold assets, and if they try to move those assets around or take cash out, they're heavily taxed, right? So this money stays locked in there. Eventually it has to come out of the corporation either through death or through other means. Purchasing a corporate owned life insurance product in Canada today, I'd say the most popular version of a product like this is participating whole life.
Yeah.
It's a product that the death benefit grows, it can grow significant cash values within the product, and it kind of supercharges all those tax benefits when you take it into consideration. So the concepts that I've written about myself and I've seen utilized are things like corporate owned life insurance. Life insurance is an alternative investment where you're taking some of that never money that you're never going to touch, and you're transferring a portion of it to pay insurance premiums so that death benefit and that cash value grows. Working to diversify investment portfolios. There's a lot of literature out there where if you take cash or fixed income assets and you transfer that to a life insurance policy, it actually diversifies a balanced portfolio in order to increase returns and minimize volatility, minimize the risks associated with that portfolio, just because of the stability that you see within the growth of these insurance products. So a lot of clients are utilizing life insurance as an asset class. They're also utilizing insurance within their corporations in order to bolster their balance sheets. So the cash value acts as an asset on the balance sheet, and you can utilize the cash for other purposes because the collateral value of that cash value, which I spoke about a little bit before, the collateral value is seen as so favorable. In many cases, banks look at participating whole life insurance cash values as even more favorable assets to lend against than real estate. And so many people are very comfortable with buying real estate and lending against it, borrowing against it. Insurance cash values even are more favorable assets in today's environment for borrowing against. So corporations are utilizing this in order to supercharge their balance sheets, supercharge and diversify their investment portfolios, and then they're using it for definitely generating liquidity. There's going to be a point in time where they're going to need cash, and no better tool generates cash than a life insurance product. We've had examples of death claims as high as $40-50 million, where a client's died and that death claim is paid out within a week. So you get cash within a week, bypassing things like probate and other estate lock-in mechanisms that require you to go to court and everything else to lock it out. Insurance bypasses all that and is paid out very, very quickly. So utilizing insurance for cash purposes, utilizing insurance in order to minimize your tax bill through the capital dividend account, like there's no other tool out there for generating capital dividends as efficiently as life insurance. By life expectancy, most of a life insurance death benefit is a credit to your capital dividend account.
Yes.
In some cases, it's 100% of the death benefit if structured properly, which doesn't even have to be used for the death benefit itself. The death benefit could be used within the corporation for needs, and then you're still left with this capital dividend to pass out other assets, other income in a very, very tax efficient, tax-free capital dividends to your inheritors. So very efficient, very powerful tool. And because of that, we're seeing an explosion of the utilization of corporate-owned life insurance in Canada. It's the growth engine for Canadian life insurance. So
wonderful, wonderful. I think this is really something, hearing from somebody like you, and very especially for business owners and self-employed professionals, the use of insurance in the corporation, how it can really help. That was wonderful. Thank you so much.
Yeah.
I really loved it. And I really thank you. This has been so informative, Mark. And as I always say that, it's not only my audience, it's not only the viewers, it's me also who learns so much every time I have a guest. And somebody from you, I really learned a lot. So thank you so much for coming here and sharing all your knowledge with everyone.
it's my pleasure, Sim. I really appreciate the opportunity to come out here. So thank you.
Thank you so much. And that was another episode of the Simple Wealth Wisdom podcast. Please let us know in the comments what you like the most about this podcast. And if there's anything else you want to see or ask, and I'll make sure to bring that to you in our future podcast. Watch for us again next week. Until next time, stay safe. I'm Sim Gakhar. Thank you.